we are diving into the California Fair Plan's failure. There is something brewing in California. About 3 weeks ago or a month ago, I did a live show all about how California insurers were leaving California and leaving the homeowners in basically in despair, leaving the state, canceling insurances in some of the more fire-prone areas of LA and the surrounding areas. And tens of thousands of people have gotten their the insurance plans canceled. Tonight, I'm talking about how the California Fair Plan is basically on the verge of bankruptcy.
There's no question there's going to be a lot of people who were impacted by this fire whose insurance falls short.
For example, the California Fair Plan caps insurance payments for natural disasters at $3 million for residential policyholders. That price tag affects at least 33 Bay Area cities, where the average home value now exceeds $2 million. That's according to data from Zillow. So what impact could this have on the housing market?
With the cap being at $3 million, you're talking about a high percentage of homes not being able to get coverage up to a certain amount. That's going to drastically change how the market's going to be moving forward.
Neil Canlis owns a real estate company that tracks market trends across the Bay Area.
We're losing a percentage of buyers because they can't get a policy, or the policies are too high in price. You're already paying the mortgage, you're already paying the property tax, and then on top of that, if you have to pay a $10,000 home insurance policy, that's $850, $900 a month.
Canlis says if the $3 million cap is not raised,
the market's going to slow down even more so. And we're already seeing the highest interest rates that we've seen in a long time. The Fed has already said they're only going to drop their rates twice in 2025 and probably only do it by a quarter point each drop. We're looking at still high prices, higher interest rates compared to where we were the last 5 years, and insurance policies being extremely high or not available.
When the insurance companies pulled out of California, they left a massive vacuum in the state. A massive vacuum. The vacuum was that they had all of these homeowners that in California that needed fire insurance. The insurance companies pulled the rug from them, and then the homeowners in California were basically left holding the bag without insurance. For years, maybe a decade or two, California has had apparently issues with insurers because of regulations. The insurers wanted to change the regulations so that they can charge higher premiums to the homeowners. Essentially, what's happening is the insurance companies want to change how the homeowners insurance premiums work, but California essentially caps private insurers in California to a certain amount of money, a certain amount of premium. Here's the problem with that. In other videos, when we were talking about California and the minimum wage for limited service restaurants, like quick service restaurants, and the video that I did, which I'll link here, when I'm talking, you can come back to it. I was talking about price controls. Now, the thing about price controls, they work both ways. A price control includes a price floor and a price ceiling. In this case, it's the opposite of minimum wage. So with minimum wage, the issue was that the California was putting in a price control of minimum wage, which is they have to pay a certain amount. With the price control that's capped, the ceiling, they're only allowing premiums to go up a certain amount. It is what it is. That's how things work there. So in any event, because of that price control, insurers have decided that it's not worth the risk of them insuring these homes that are in high risk areas, because they're essentially not going to be able to get covered in case they have to pay out claims in these high risk areas, because they are more prone to certain weather events, natural disasters like wildfires, like mudslides, and anything else that California goes through, which almost no one else in the continental U.S. goes through in terms of weather for the most part. And so they decided to pull out, right? And so California had to start what they call the California Fair Plan, which is what's an insurer of last resort. This is essentially when there's no other insurer to be able to insure the homeowners in California. California decided to create this massive insurance fund to cover homeowners so that they can be insured when there was no private insurer available to cover the homeowners in California. What's the problem with this situation? Number one, all of the private insurers left because they absolutely could not raise the premiums, which would have cost many, many thousands of dollars, but at least they would have stayed and they would have covered homeowners. So you can make an argument about whether or not a homeowner will want to pay an exorbitant amount in premiums because just for sake of living in California. Here's the problem. The problem is that fund that the state of California created, the Fair Plan, as the insurer of last resort for these homeowners, is basically broke, and it's running out of money. There's been some question about whether California's insurer of last resort, the Fair Plan, has enough cash on hand to pay for its share of wildfire claims, as surplus is inadequate and reinsurance has a deductible that exceeds available cash. An industry assessment is inevitable, a Fitch analyst confirmed. Fair Plan, Fair Access to Insurance Requirements Plan, doesn't have enough surplus for this level of loss. The biggest California wildfire loss to date, said Gerald Glombicki, senior director at Fitch Ratings, in an interview with Insurance Journal. This means insurers writing business in California ultimately will have to bolster Fair Plan's financial position, as will homeowners across the state. Nearly a year ago, Fair Plan had $336 billion of property exposure, with surplus of just about $200 million and $700 million of cash on hand, said Victoria Roach, who testified before the California Assembly Insurance Oversight Committee on March 13th. According to the Fair Plan statistics, it has $5.9 billion of exposure to the Pacific Palisades, where the fires are raging, or raged. Its fifth highest wildfire exposure concentration. Look at that. Not only are your premiums going to go up so they can replenish their ability to pay these policy claims, but they're going to assess you as well. And that assessment could be $1,000 or more dollars extra annually in addition to your insurance premium. I don't know how you feel about that, but it is a big problem, because if you're already struggling financially and you have a home and you're doing everything you can kind of just to make it through, this is not a great time right now to be in this situation. It's kind of tragic, you know? Yeah, it really is. I'm sorry that y'all are going through this.